Hi everybody. We hope you and your loved ones are all healthy and doing well. Everyone at Mercer would like to say a big thank you to all of the dedicated workers who are providing essential services during the lockdown, and to all of the frontline workers tending to those directly affected. The coronavirus has affected all areas of human activity, including the stock markets. It's very understandable that some people are nervous about how their pension savings will be affected by movements in the markets, and have plenty of questions about whether they should do something about it, and if so, what? Hopefully this video will help to answer those questions. It is important to note that this video does not offer personal financial advice. If you are considering changing your investment arrangements, we strongly recommend that you seek personal advice from a qualified financial advisor before doing so. That said, for most people, especially those 10 or more years from retirement, the current market volatility is unlikely to have a major long-term impact on pension incomes. Generally speaking, it is not advisable to change long-term investment arrangements in response to short-term market events. So, for most people, the best approach to protecting the value of pension savings may very well be to do nothing at all, and to leave pension savings invested exactly as they are. Let's say Bob's pension savings are currently worth €10,000. Right now, his savings are invested in 100 shares in growth funds, each worth €100. But the markets shift and growth funds fall in value to €50 each. Concerned about them dropping in value even more, Bob decides to move from growth funds to conservative funds. But by moving when markets are low, Bob sells his shares at a reduced price. When the markets do recover, he buys back in at the full price. He doesn't benefit from that recovery, and his savings are locked into a value of €5,000. Trying to time the markets is difficult at the best of times, even for professionals. Trying to do so when markets are moving as fast as they are, and when it is very hard to know the real value of stocks and shares, is nearly impossible. In fact, many people make investment changes at exactly the worst time to do so. It is also important to note that changing pension investments does not happen instantaneously, and can take anywhere between a couple of days and a month, depending on the particular investment managers involved, which makes timing the markets even more difficult. Best practice when saving for retirement is to invest in growth funds when you're far from retirement, and to gradually move to conservative funds as you get closer to retirement. This lets you aim for maximum long-term growth when your savings have time to recover from any market dips, and helps to protect your savings when they have less time to recover. The good news is that most pension plans offer automated investment strategies that can automatically manage this process for you. The terminology differs from plan to plan, and in your plan's case, might be called an Aspire retirement strategy, a lifestyle option, or lifestyle strategy. As lifestyle strategies are most plans' default investment option, there's a very strong chance that you're invested in one, and that your savings are already being managed with potential market ups and downs in mind without you having had to take any action. Lifestyle strategies are designed with investment best practices in mind and are suitable for 90% of plan members. However, no one investment solution fits all. If you plan to retire earlier than age 65, a lifestyle strategy may not suit you, as your savings might continue to be exposed to risk as you get closer to your target retirement date. Lifestyle strategies target a specific package of benefits at retirement which might not align with the benefits you want to take. If you are close to retirement, you may have the option of moving some of your pension savings to an approved retirement fund when you retire. This will allow you to keep your pension savings invested and allow them to continue to aim for growth and hopefully recover from any short-term falls they might have experienced. If the value of your pension savings are affected by market movements, there may be a silver lining. As market prices drop, the cost of shares becomes cheaper, so you can buy more units for the same amount of money. When the markets recover, you will have more units at full value. If you can afford it, this may be the perfect time to consider increasing your regular pension contributions. So, let's review the information we've covered and look over the best practices for dealing with volatile markets like the one we are currently experiencing. These are general guides, not personal financial advice. Before taking any action, you should consider getting personal advice from a qualified financial advisor, especially if you are 10 or less years from retirement. So, here are some questions you might want to ask yourself. Are you close to your target retirement date? If not, doing nothing may very well be your best course of action. And you might also want to consider increasing your contributions to take advantage of reduced share prices. If you are close to retirement, are you invested in a lifestyle strategy? Bear in mind this is likely to be your plan's default investment option, and if you never made a personal investment decision, the answer is likely to be yes. If you are invested in a lifestyle strategy, you're probably in a good situation, as this will already have started moving your savings to more conservative investment options. However, you should consider, do you plan on retiring at normal retirement date? And does the benefits package targeted by the lifestyle strategy reflect your retirement plans? If the answer to any of the last three questions is no, the lifestyle strategy may not be suitable for your needs. If you are close to retirement and invested in a lifestyle strategy that is not appropriate to your personal retirement objectives, or you have made your own personal investment selection, you might want to ensure that your pension savings are invested in conservative funds appropriate to the benefits you plan to take at retirement. You may also wish to increase your contribution rates to take advantage of reduced share prices and to make up for any potential drops in the value of your savings due to short-term market movements. And you may wish to consider continuing to invest your pension savings after retirement via an approved retirement fund. For more information about the investment options available to you and best practices on investing your pension savings, see your plan booklet or investment options guide. As noted earlier, this video is based on investment best practices and does not take your personal circumstances into account. Before you take any action, we strongly recommend you get personal financial advice from a qualified financial advisor. We wish you all the best in these turbulent times and that you and all of your loved ones stay safe and healthy.